So unpopular opinion, but we actually need a recession. Now I know that's probably not what you wanted to hear when you clicked on this video, but hear me out because some of the economic theory that I'm going to present is certainly quite compelling. And actually, if we don't fall into a recession almost imminently, some of the current economic challenges that we're facing into can only get worse. But let me just say this, it's certainly not going to be pretty and there will be catastrophic effects in the short term, and I think we're probably all going to struggle to comprehend the magnitude of. But I can tell you without a shadow of a doubt, you will likely be impacted in some way. Now I'm sure many of you guys are aware of this already, but let's strip things back to basics and talk about how exactly an economy works. Now simplistically, an economy works in cycles, and this type of cycle is a correlation between economic GDP and time, with economic GDP of course being the collective market value of the output of an economy. Now during some periods of time the economy grows, just like we saw after World War II. It's typically where we have periods of high public spending, higher levels of employment, output certainly increases and everything looks great. Then we also have periods of time when the economy is contracting, just like we saw back in the financial crisis. This is typically where unemployment rises, business profits fall, and some companies even end up going bankrupt. It's more formally known as the boom and bust cycle, which happens usually every 7 to 10 years. But what's also recognised by economists is that these boom and bust cycles typically trend upwards over time. And as of right now, it certainly feels like we're on the downward leg of the cycle, certainly looking like we're entering into a recession. And that's certainly what all of the forecasts are saying as well. Now some may say, well, this is all just part and parcel of economics, but you could also potentially put an argument forward that it's also been manufactured in this way. Let me explain a little bit more about what I mean by the manufactured economy, especially in the past 2 years and the impacts that it's had. Because all of the consequences of the decisions and actions that were taken in the past 2 years are certainly going to impact us, well, they're already impacting us already, but they're going to impact us more so in the coming months and years ahead. So let's start with the demand side. During the pandemic, the economy was kept afloat with stimulus checks, furlough packages, along with stamp duty holidays. And as a result, we had all of this new money, or free money if you like, come into circulation. The British public got comparatively richer, or perhaps rich is a little bit too strong of a word, but they were comparatively better off than what they were before. And as a result, as lockdowns were started to be lifted and people could now spend all of their money, the demand for goods and services went up. And when we look at a typical supply and demand curve, going back to my university days studying economics, when you have demand for goods going up and supply remains constant, prices inevitably rise. The result of which I guess you could argue has been somewhat manufactured, almost predictable in some senses, because house prices are now at record highs at an average of about £294,000, and even used car prices are up 27%. So we've got something called demand push inflation, which in essence simply means that the more people are demanding goods and services, the higher the prices of those goods and services will rise. But then on the flip side, we also have the supply side, with all of the global supply chain challenges which we keep hearing about, but they are certainly a little bit more out of our control. But nonetheless, some of these challenges have resulted in fuel prices going up to £2 a litre a couple of months back, and even now where pump prices are down ever so slightly, they're still up 64% from last year. The price of construction materials like steel and timber have also increased in the realms of about 80%, and that's even before we throw the energy prices into the mix, with the energy price cap going up by 80% to £3,549 this winter. Now when you combine factors of a shortage of supply along with increased demand, that further hikes prices higher, which is why we're now facing into the Bank of England reported inflation figures of 10.1%, which in reality, or in real terms, is certainly far higher. So that's the situation, but how does the UK government along with the central bank essentially come together to unravel this mess that we're in, and in essence go on to, I guess you could say, manufacture an economy with lower levels of inflation? Well, the obvious answer to that is to ensure that we enter a recession. Now you might be thinking, well, surely that's stupid, why on earth would they actually want us to enter into a recession? Because a recession is a period of time where people become poorer, businesses make less profits, and unemployment starts to rise. And whilst that's the case, it's actually one of the only levers that the UK government and central bank have to pull is to actually put us into a recession in order to make us all poorer. Because inflation, as I've explained, is a byproduct of increased demand along with reduced supply, or both. And one of the only ways to stop prices rising is to simply stop people spending. And the way in which they can certainly look to do that is to attack the demand side of the equation. Because if you can make people poorer, they'll stop spending money because it will reduce the demand for goods and services. Sounds brutal, but it is also true. Because despite all the train strikes, along with strikes on the docks, it's actually all quite pointless that the unions are requesting inflationary level pay rises, because it simply doesn't solve the inflation problem. In actual fact, it exacerbates it. Let's say we've got an imaginary figure called Boris who currently earns £30,000 per year in this current environment of 10.1% inflation rates. Let's say that we give Boris an extra 10.1% pay rise this year, increasing his pay to £33,030. So in essence, an extra £3,030 more than what he had to play with previously. By definition, more money doesn't bring lower prices. It simply doesn't make sense. In actual fact, more money provides more purchasing power, and the more people purchase, the higher that prices will rise. It is simply just the law of economics. And of course, the UK government and central banks all know this. It's why the central bank have started to increase interest rates, and why the UK government haven't exactly been forthcoming with handing out any more free money. So as a result, it's a necessary evil, if you like, to send us into a recession. So how exactly are they going to do this? Well, there are certainly two ways that I can think of, but if you've got any other ways, then be sure to leave them down in the comment section below. The first one, and probably the most obvious one, is through energy prices. Now let me be absolutely clear, the UK government do not control energy prices, and they cannot have any effect whatsoever on the amount of money that you pay to the likes of Shell or British Gas for your gas and electric every single month. That's more of a macro problem that's supply driven, and it's simply as a result of the UK needing to import so much of their gas and electricity simply because we're not self-sufficient. And because we rely so much on the continent for our energy supply, and because we're not self-sufficient, we've kind of got our hands tied, and we inevitably have to pay higher energy prices, because that's what the market demands. Now, of course, this problem has largely been exacerbated by the Russia and Ukraine crisis, because Russia are a large exporter of natural gas. But nonetheless, with such a risk premium priced into energy markets right now, it's made the price of gas and electricity look like something like a meme stock of 2020. And it's simply the reason why the energy price cap continues to rise. And in actual fact, the forecast is that it's only going to get worse from here, with some forecasts suggesting that it could rise to over £5,000 in January 2023 and up to £7,000 by April, which is absolutely mental. Now, the impact of the rising energy price cap has disaster written all over it. And this is absolutely no joke, but I actually had someone from EDF come to my front door today to actually give me tips on how I could potentially save money on gas and electric over the winter. It's no wonder why we're now seeing reports that 1/3 of Brits could actually face fuel poverty by 2023, which is actually the equivalent to over 10 million households. Now that certainly sounds quite shocking, but with energy bills now being the equivalent potentially to some mortgage repayments, it will certainly reduce the demand for goods and services, and it will inevitably stop people spending. And when you've got consumption reducing, businesses' profits will start to slow, the velocity of money will also start to slow, and before you know it, those scary inflation figures will certainly look like they're a little bit more under control. Now, the energy crisis is certainly a problem in itself, but the central bank also have another lever to pull, and that's to hike interest rates. And this is one of the monetary policy measures that the central bank can put in place in order to stop people spending and cool inflation. It inevitably goes back to the point around increasing people's outgoings via the means of like mortgage repayments and loan repayments in order to make them poorer. Because with the central bank base rate continuing to rise, the people that, let's say, would spend 50 quid on the weekend going out for a meal, perhaps might even spend £100 on a pair of trainers this month, potentially even renew their phone contract for 50 quid, now all of a sudden can't afford to consume or buy those goods because their mortgage payments have gone up to the equivalent of that £200 per month that they previously would have spent. And with that, naturally, demand will start to fall. And therefore, theoretically speaking, the price of goods will start to fall too, and therefore have a positive effect on the inflation rates, which is exactly how you manufacture a recession in order to cool the economy and reduce the levels of inflation. But I'd also certainly think that there is a balancing act to play here, and very much a huge responsibility for the UK government and the central banks to be very much in tune with the UK public, which, let's be honest, 9 times out of 10 they're not. Now, the reason why I say this is that we've got energy prices continuing to spiral out of control. We've also got interest rates also rising too. If that continues to happen in conjunction with one another, then it will continue to have an adverse effect and a squeeze on consumer finances, at which point we're not only looking into a potential recession, but we're potentially looking into something like a 1930s Great Depression. And in my personal opinion, the UK government and central bank can only allow it to be one or the other. Either stick an absolute cap on energy prices and only allow them to be changed every 6 months instead of the 3 months that they're being changed now, or interest rates need to stay low instead in order to keep somewhat of a cap on mortgage rates, loan repayments, and any kind of debt repayments that people have. Because if both go up in tandem, it will financially send people under. But what I do certainly believe is that it's necessary to have somewhat of a short-term limitation on the surplus cash that the public has, because if you can limit that surplus cash going out into the economy, it will cool the levels of inflation. And whilst I certainly acknowledge the fact that some people today already don't have the surplus cash to play with, is why I said at the top of the video that I'm expecting some catastrophic effects as a result of this crisis that we're in. I'm obviously no economist, but I certainly just don't see another way out of this in the short term. Something certainly has to give, and I think we can all probably agree that the public always seems to be the ones that end up out of pocket, regardless of which way you look at it. So with that said, guys, the necessary evil of a recession may be upon us, but if you are interested on how to protect your investments during a potential recession, then be sure to click on this video next. With that being said, see you over in the next one.